All right, welcome to another episode of our wealth building podcast. And I have a special guest, my twin brother, who's not my twin brother, but might look like it. So we're having some nepotism today with my brother Josh Manwaring, who's a financial advisor here in the Phoenix area. And excited to have you come on and help us understand some of the key principles to building wealth, because this is what you do every day with your clients. So welcome on.
Hey, good to be here.
So tell me about a little bit about your business and the folks who are listening. You're a financial advisor. I believe you're a fiduciary, but you can explain that a little bit better before we jump in.
Yeah, so there's a lot of people who call themselves financial advisors, so we come in all shapes and sizes. I am a fiduciary, so I have a registered investment advisory firm, and I help clients manage their assets. I help them do financial planning, and typically my clients are people who have been building wealth throughout their lives, and then they come to me and we help prepare a plan to prepare them for retirement. We work with lots of different clients, but that's typically who we primarily help the most.
So when is the right time for someone to seek advice from a financial advisor? I mean, should they do that when they're just starting to build, some income and they're putting money away in a 401k and they're just starting that? Or is it really something they should do later once they've established some net worth? What's your opinion on that?
We get asked that question a lot. And, my advice is anytime you can get a professional to give you some advice or direction, take that at any time in your life. Now, that doesn't always mean you can afford or it means you need an advisor. But if you speak with an advisor and get some advice about, how to allocate your 401k, how much to put in your 401k, is it better to do the Roth 401k? Do I invest outside the 401k? Do I do a Roth or just a regular IRA or just save or buy real estate? The thing about working with a financial professional is we typically are looking at the holistic plan of somebody, and we can give you some advice, whether we become your advisor or not. Most advisors are willing to give you some advice and recommend. If you're just getting started, the key is to psychologically just start investing, start saving. What you save in really is, it doesn't really matter whether you're putting it in the savings or you're investing in a 401k or the market or real estate. The key is to just learn that pattern and learn that behavior of putting some money away, not spending everything, and starting to build some kind of a nest egg to do something with.
Once you've started that process, you'll probably want to get more sophisticated about how you allocate it and a little bit smarter about your plan toward retirement. And I think that is good advice. Like you're saying, if you can talk to a financial advisor, it's always helpful. It's kind of like if you can get free advice from an attorney that you are friends with or you go to a club with, you just talk to them the whole time that you're lifting weights about your problems. I know with over the years with you, I've always ran questions by you because I know what you're seeing, and you probably get cornered a bit. You're giving that free advice, which is a good way to learn. But ultimately, when you start working with a financial advisor, how do you get paid by the client? How does that work? Do you charge them hourly, or do you just charge them an annual fee? Or, if you're starting that process, how would that work?
Yeah, so just to go back to your last point, maybe if you're not necessarily to the point that you want to hire an advisor, maybe ask your parents who their advisor is. And like on a weekly basis, I get calls from my clients' children about advice, and I'm totally open to give them advice and work with them. And sometimes it's just kind of knowing someone to do that.
Sure. Yeah.
When it comes to work with advisors and how we get paid and compensated, they're all a little bit different. Some advisors will get paid a commission. When you invest with them, they'll get paid a commission. You have to be a little bit careful when that happens because it's hard to tell if they're giving you advice or they're trying to sell you something.
Yeah, that's always a concern. Yeah.
So my practice is just fees. We charge what's called a fee only, where we charge our clients a percentage of their assets, like a 1% fee. And we charge them that on an annual basis. And then the investments that we put them in, they know that we're giving them the best advice because we don't get paid from the investment companies.
And if you're generating some alpha or some return on that portfolio, then your fee can just come out of that return. So if
Absolutely.
they're getting a 10% return, then they pay 10% of that to you, which is 1%, and then they keep the other 9%. But that makes sense from an advice standpoint.
Yeah, and just on that, some people think, well, why would I want to pay an advisor 1%? And I totally get it. But a lot of times we're helping, encouraging, and holding the person accountable to invest, to create a plan, to stay invested. Because a lot of times when someone's left to their own devices, they're moving their money all around and chasing their tail and not even getting anything done when they think that they are.
Right. It's good to have that coach. And it's also, with my experience working with you and other financial advisors, you have access to information and to tools that are pretty sophisticated, especially when it comes to planning for retirement, ensuring that you're going to have cash flow in retirement. And the most wealthy people are working with financial advisors for a reason, because they get a bang for their buck. And so you need to have a good advisor, obviously, but that makes a lot of sense. I think one of the things I want to dive into initially is this idea of how do you set up your investment strategy? And you actually turned me on to a book by Tony Robbins, who is not necessarily just a financial a guy, but he's a really smart guy. And this book is actually really good, called The Holy Grail of Investing. And I just went through it. And Tony does a really good job in his research. And he basically interviews some of the most successful investors in our generation, including Ray Dalio, who he quotes a lot. And one of the things that he asks all of them is, what is your holy grail of investing? And when you think of holy grail, it's like, the secret way to do it the right way. If you think of finding that holy grail. So that's how Tony describes it. And what Ray Dalio says is his holy grail of investing is having 8 to 10 assets that you really like that are not correlated, which means that one might go down while the other goes up. When assets are correlated, they tend to go down or up together. So that was Ray Dalio's holy grail of investing. So each of us need to figure out as investors, as we start placing our money and our income and putting into different buckets of assets, how we're going to do that. How do you think about, from a high level, people should allocate their assets, and let's just talk about an average person that might have a few $100,000 to allocate. How should they think about that across different asset classes, stocks, bonds, and then real estate and alternatives as well?
Yeah, so a client came in about 6 months ago and asked me a question. He says, what is your average return for your clients? And I said, I have no idea. And the reason is because every client has a custom portfolio. And so what that means is investing is as much of an emotional game as it is a financial and numbers game. So, how to allocate a portfolio, the very first thing that we really look at is, you have to understand what the time horizon is. Meaning, if you're going to start investing money, when do you need that money? Are you saving that money up to have a down payment on a house a year from now? Or is this money that you're going to earmark for retirement 30 years from now? That investment allocation will be completely different. So most of the clients that we work with typically are investing long term. It also depends on their age. Are they going to need this money 5 years from now because they're getting ready to retire? Well, that portfolio is going to look very different than the person who's just started working and they're putting money away for retirement 30 years from now. So when you start thinking about investment in portfolios and allocations, you hear these terms, things like a 60-40 portfolio or a 70-30 portfolio.
And what does that mean, just for people who haven't heard that?
It's an interesting term because Wall Street's the one who made that up. And they made that up because it made people feel like they're really getting diversified, which they are. You know, if you're in a 60-40 portfolio, typically 60% is the equity side or the stocks. The 40% side will be the fixed income like bonds. And the idea behind that is these investment allocations will rise and fall at different times, so they'll kind of offset each other.
They're not correlated.
They're not correlated.
Those two.
They're not correlated. And so it's a real kind of vanilla way to look at things. Very few people are actually invested like that, although those are really good ways to start. The challenge becomes throughout time, those things don't always respond and act like they have years before. So they're always changing. Interest rates change, for instance. So if you're going to be in a bond portfolio and interest rates are 2 or 3% like they were for decades, well, that kind of an allocation is not really going to get you very far. And so you have to be a little bit creative to be able to adjust those. And so you have to expand this. I'm only going to own stocks and bonds.
So let's give you a specific example. Let's say a 40-year-old who's making good money, and they're trying to put away $40,000-$50,000 a year into retirement, and they have a couple $100,000, but they're 40, so they plan to work for a long time, you know. And retirement is also a moving number. Some people aren't ever going to retire. Some people think they'll retire when they're 80. I think the government will start paying you at 65, Social Security, so that's kind of the government age. So, but at that point of a 40-year-old, how would you help them think about what they should have in their portfolio with stocks, bonds, alts?
Yeah, so again, it will be pretty customized, but in general, it's really hard to tell a person who's 40 to not own any stocks, because if a person has 20, 30 years, history shows us that stocks are going to perform pretty well. You know, they're going to get them somewhere between 8 and 12% over that period of time. And the thing about stocks is they're pretty much a passive investment. You don't really have to do a lot. You just invest and you can just hold it, whether that's in an ETF or individual stocks or a mutual fund. So the key is to find that right kind of mix there. So I'd probably encourage a person that age to be 40, 50%, maybe even higher into equity, specific stocks, maybe 60%. The challenge becomes, you know, a lot of people kind of have a little itch that they want to do other things. They want to see their portfolio not just go up and down with the stock market. They want to invest in other things. So, you know, things like real estate or other types of fixed income investments that you can slide into that portfolio that will have good returns over the years. They also act differently. The characteristics are different. They're not always moving up and down like that. And sometimes emotionally, it's nice to see part of your portfolio that just has a lot of the volatility taken out, to where you don't open up a statement or you look at your statements when things aren't going well and you just freak out and make bad decisions. So part of having other things than stocks in your portfolio is more of it's not only good financially, but it's also good emotionally. It kind of stables things out.
And like you're saying, that really depends on the personality of the person, how much of that they want to put into those types of investments. If you watch CNBC or Bloomberg, they assume everybody puts basically everything into the markets, which is stocks and bonds, public markets. But the big growing asset class are private investments, private equity, private real estate, venture capital, private debt, all of these areas that are really growing fast. And from the standpoint of a financial advisor, how do you view the alts? What do you tell somebody who's looking for your advice of how much they should put there? Obviously, it depends on their age. Let's go back to this 40-year-old. How much should a 40-year-old put there from a financial advice standpoint?
Well, so I look at it kind of as a fiduciary, and I kind of look at lots of pieces about that. So one, if the person's saving at a really good clip, and they have the ability to, you know, you're putting money away, and you have a nice position in, you know, stocks and bonds. The thing about stocks and bonds is these are market-based investments that are very liquid, meaning you can kind of get out and in on these investments pretty quickly. The trick when it kind of moves into these other more sophisticated investments like private equity or private real estate is they are a little more sophisticated, and not everybody can participate in them. And so they have to have certain income or certain assets to even be able to participate in them.
Yeah, that's kind of a select club of people who can qualify. You have to have, in many cases, be an accredited investor, which means $1 million net worth or several $100,000 a year in income. So there's already a limitation on what they can participate in.
Well, and it's almost kind of like the rich get richer, and it's like because they have access to some of these investments. However, things are changing, and there's ways to invest in these that can be very, very profitable. It can be fantastic emotionally to know that you're investing in other things. So, when a person decides they want to invest in some of these alternative investments, I've seen clients put all their money in those. The challenge when they do that is it can create a liquidity problem from time to time, where some of these investments might not pay for a while, or they might have some issues, and so it can kind of create a little bit of a cash crunch for the investor. So typically, for someone younger, they probably, just as a rule, probably don't want to put more than 20 or 30% of their portfolio in something like that, and make sure they understand what it is and how it works and the liquidity. But typically, when they're investing money that's earmarked long term, that's typically not a problem. You also just need to understand that life changes, and sometimes you might need that money before.
Yeah, and I think what we were talking about earlier about what is this holy grail of investing, or how do you do this the right way to have all your assets in one place, especially if they're all locked up. There's better ways to do it. We do have investors who invest with us who put a majority of their funds with us because they just like an asset class. In our case, multifamily real estate. So they like it. They'll put it in there, and they don't like the stock market at all. But you have to commit to that term. How long are the funds going to be locked up? Because you can't, sell it a few months down the road. And then when you think of diversification and having a portfolio that isn't correlated, it makes sense to allocate that. Maybe it's as much as a third in that asset class, but then having a third in other areas. And let me ask you about one other asset class that's definitely popular with younger folks and more tech folks is cryptocurrencies. So what advice do you give generally around cryptocurrencies for your clients?
I'm real honest. It is not my specialty, and I have studied it. I have clients who ask about it quite a bit. I don't think it's going anywhere. I think it's going to be around a long time. I have several clients who own it, but they own it outside of the portfolio that we manage. We just recently have started to integrate it as a little piece in our portfolios now that there's a publicly traded ETF.
Yep.
So for our aggressive portfolios, we're using a little slice of, a Bitcoin ETF, which has just proven it's not going anywhere. So I can't really talk too much about, what the future that might hold or what kind of allocation. I would just tell people to be a little bit careful being way too overweighted in that. At the same time, I've seen people put everything in it and do really well, and I've seen people put everything in it and do absolutely lose it all.
And a lot of volatility there. And when we say volatility, that's a lot of up and down.
Yeah.
So if you're going to ride that roller coaster, be prepared. And one of the nice things that happened this year with cryptocurrency is that some large institutions offer ETFs now in cryptocurrency, Fidelity being one of them. I had friends who lost money in cryptocurrency because of the exchange that they were on. We all know about FTX and Sam Bankman-Fried and the fraud that was going on there. And that was tied to not the cryptocurrency itself, but the custodian and the exchange that it was on. And he's not the only fraudster out there with cryptocurrency. I know many of these Asian, primarily couple that were in Asia, exchanges that also lost people a lot of money. So it's nice now that you could have the kind of the blessing of a Fidelity, of a Schwab, and you can buy the ETF. And that's definitely opened up the market, I think, to more of a mainstream investor.
And kind of on that, one of the things you have to kind of think about of all of these investments is how they're valued and how emotionally you can handle that. As an example, if you own private real estate, typically private real estate, you really don't know what it is day by day. You know there's an income coming in. You know there's a stable valuation. You own a real asset. You don't unless you're checking Zillow, which doesn't really give you an accurate number on a daily basis. It's just kind of a long-term investment. It's not super emotional. When you own stocks or bonds, you can, anytime while the market's open during the week, you can see the valuation going up and down, so there's some volatility. When you own Bitcoin, it's 24/7. It never shuts off. And I find people who own any type of cryptocurrency direct, they're looking at it all the time. And if that's what you're into, great. It's not a way to really live life unless that's kind of your thing.
Yeah, and the other thing that crypto is still a mystery to me is that it's similar to gold in that it doesn't generate cash flow. It's an asset, and there's some value, perceived value, real value there, but there's no business underlying it. If you invest in a stock, there's cash flows from that. There's assets that are behind that stock. So that's always been one of the interesting things with crypto is it's a form of currency exchange, but there is no underlying asset underneath it other than that. Yeah. But it's proven that there's enough people willing to buy it, that there's a market for it. And gold's not, dissimilar in the way that there is value obviously to gold, but if you buy gold, you're not melting it down and making jewelry out of it. You're just buying gold because it's a different asset than cash or other stocks or bonds. So totally. It was early on a mystery, and now I think people are kind of accepting that it is a valid asset.
Absolutely. When you see these huge global custodians creating ETFs and large pensions and large funds investing little pieces in it, that's when I was like, I'm okay putting that in some of my portfolios.
Yeah, I think a lot of people feel the same way. Mm-hmm. So let's talk a little bit about our current landscape. Stock market's at all-time highs. Recently, we got news from the Fed that inflation seems like it's under control in their view, so they're going to be able to take interest rates back down. Chairman Powell was pretty specific last week in Jackson Hole that, interest rates, it's time for them to come down. So really signaling that that's the direction that we're going. So stock market rallied on that. At the same time, some of the economic factors are starting to get a bit softer. Unemployment and hiring numbers are starting to come down. So there's a lot of questions about the economy, but stock market's done really well. So first thing is kind of what's your outlook for the remainder of the year? Here we are, late August of 2024, and then also what are investors thinking about right now when they're talking to you about their portfolio?
Yeah, so my outlook is the same that it always is, and that's I have no idea. So again, that's why it's important to kind of know when you invest in the market that you're looking at it long term, and you're just being prepared for all sorts of things that you can't even predict, knowing that 5 to 10 years from now it's going to be up. On the short term, the challenging thing about investing in the markets are you see the news every day. Everybody's talking about it. There's TV stations that are just talking about it, and they're talking about the day-to-day movement of a long-term investment for the majority of investors. So, my clients are always asking about it. We do talk about it, but at the same time, what it does in the next 3 to 6 months is kind of irrelevant for people who are investing. Now, if you're a day trader and you're going in and out of the market on a daily basis, that might be a different conversation. But for most people, they have to understand that through these political cycles, election cycles, there could be some movement that is unpredictable, but there's that on a daily basis. Just like the thing in Japan a couple of weeks ago, when they had that carry trade issue and the market really got nervous about it and it dropped significantly, but it came back. There's things that can happen that we just don't know. And I'm realistically, I think if the interest rates do start to come down like it sounds like they will, that's not a bad thing for the market. Companies like cheaper money. It helps them deploy capital a little bit easier to service debt, those types of things. While at the same time, you just don't know, what that could mean. So again, any type of investment like this, you have to understand that these cycles will happen, and you have to be okay with whatever the outcome is.
I think that's probably one of the biggest things investors need to understand is that having that long-term perspective, and there's a difference between being a day trader and a buy and hold investor. So is that part of you feel like your role is helping people to get through some of the anxieties that they come if they're watching the news too much and they're saying, hey, Josh, I need to do that. What should I do? And you're helping them say, hey, we just need to see it through. It's going to be okay. The things aren't going off the rails. We're going to get there.
No question about it. I mean, and a lot of that work that I do is almost more on the front end. I tell my clients right up front, if we're going to work together and we're going to make these investments, and 6 months from now the market dips and you're down by 10% and you call me, here's what I'm going to say. I'm going to say, we expected it. We planned for it. We don't have all of your eggs in this basket. These are expected things to happen, so we have to let the cycle play out. And I tell them up front, my job is to keep you invested in the market because we know historically that's the best way to do it. Jumping in and out is it's harmful.
Well, it's almost like where hedge funds were originally created was to just preserve your capital, not lose too much of it. And that's where the name hedge fund comes from, is hedging you from risk. So you help people individually that if the market does come down 10%, that's probably going to happen at some point. We're going to be able to live with that because we've properly allocated your portfolio.
Absolutely. It's for someone who wants to try day trading, what the market does long term is irrelevant because they're looking at such a short window. We know that the cost of having good returns in the market is being able to deal with the volatility. I'll say that again. The cost of earning good returns in the market is being able to deal with the ups and downs of the market. So you have to understand that going in, and most investors do. Where people get hurt is where they go in and their account goes down a couple $1,000s in the first couple weeks, and then they get out and they say, oh, the stock market just loses money for people. And it does for those types of people. But for people who will let it ride through that, it typically can do okay. It's very similar, might be someone who fix and flips his real estate. If they're a fix and flipper, they're getting in there and out really quickly. That's different than a long-term investor that says, hey, I just would like a nice, stable return on my money, passive income, not worry about it. I'll do my thing over here, my job or my side hustle, whatever that is, and then I'll invest in things that are passive where I don't have to manage them, and I've got professionals doing that for me.
Yeah, and that's what a REIT fund that's long-term invested in real estate tends to do the same thing the market is, and that's solid returns over time. But you have to commit to being patient. And the nice thing is when you do that, a lot of that anxiety goes away because you don't have to worry about a lot of this noise, and you just realize that it will work itself out rather than being tied to every news item every day and what might happen. It's good for the balance sheet, and it's also good for our mental health, I think, as well, being long-term holders.
Yeah, absolutely. And real quick, I'll say all money has three characteristics. It can either be liquid, it can be safe, or you can get growth. It can have two of the three. It can't have all three. So it can either be liquid, safe, or you can get growth out of it. Money in the bank typically has no growth, but it's liquid and safe. Money in the stock market is pretty liquid. It's not real safe, but you can get growth. Real estate investments are pretty safe. They get growth, but they're not real liquid. So most investments can have two of those three.